Well, Canada has consistently lagged the United States when it comes to economic growth. That divide has widened in recent decades. However, a change in interest rate policy from our central bank could play a role in reversing some of that. According to forecasting from TD Bank, the prospect of lower rates in Canada and beyond could soon lower the U.S.'s growth advantage. And for more on the long-term outlook, let's bring in James Orlando, who's a senior economist at TD. James, nice to see you.
Yeah, you too.
Okay, so walk us through the thinking here. The Bank of Canada just cut interest rates for the first time in 4 years. The U.S. Federal Reserve has not cut rates, and that opens the door for some gains for the Canadian economy vis-a-vis the U.S. economy?
Yeah, so for the last 2 years, Canadians have been suffering the weight of high interest rates. We in Canada, because of our high levels of debt, are much more sensitive to higher interest rates. And so now looking forward, we keep wondering, when is Canada going to have its time to shine with respect to high economic growth? And really the change in interest rate policy, going from the Bank of Canada having 5% policy rates to continuously likely cutting over the next year and a half, that is a big tailwind for Canadians, where we're going to be able to have less of our disposable income going to mortgage payments. And so that, in effect, will be able to close a little bit of this gap between Canada and the United States because we just have been suffering under the weight of these high rates for just so long.
Let's just talk a little bit about the path on rates that you're projecting out, because everybody gets obsessed with the short term. Like everybody's wondering right now, does the Bank of Canada cut or not cut, for example, in July? Yeah. But if you think of the next year and a half, we've only seen one 25 basis point cut by the Bank of Canada so far. What would you think is a realistic assumption for everyone right now? Yeah,
so obviously the next meeting is in July. Whether they cut or not, that's up for debate right now. The point that we're trying to make is that whether or not they do cut in July, they are in a cutting cycle. So they could cut in July or they can cut in September. Now, our view is that they're going to cut in September. They're going to have probably wait another meeting and then cut again in December. Now, this is opening the door for going from 475 to 425 by the end of this year. But it's not going to just stop right there. We're expecting further cuts, getting to 2.25% by the beginning of 2026. So that's a big difference. So getting to around 2% interest rates from 475 right now, that's a big change. That's a big shift in the interest rate dynamics in Canada.
So when on the subject of outperformance versus the U.S., where everybody's talked consistently about a resilient consumer, does lower interest rates, if people don't have to obsess on doing the math around things like mortgage payments or whatever, it gives people wanting to spend in the economy. Is there a currency differential between Canada and the U.S. that maybe allows for our export story to grow? Like, what are the catalysts for growth based on this interest rate cycle?
Well, the obvious thing is when you go from 475 to do something percent interest rates, when someone decides to get a mortgage at a bank or they decide to get an auto loan, it's going to be cheaper for them to be able to afford those interest rate payments. So that's a big change for people in their dynamics of, whether they're able to even buy something, and also getting more certainty over the path of interest rates. We had so much uncertainty in Canada for a long time, and now we're getting more certainty. That's great for positivity for consumers, but also businesses. We actually think that business investment is going to start picking up. There's a lot of big projects underway in Canada, specifically in the EV and the battery space. But to your question on currency, with the Bank of Canada cutting earlier than the Fed, and likely bringing rates to an even lower level, so widening the interest rate differential between Canada and the United States, that is going to weigh on the currency. That's going to weigh on the Canadian dollar relative to the U.S. dollar. Now, for exports, yes, that is good news for Canadian exports. And at a time when there's been so much investment in export potential in Canada, you've seen, for example, Kitimat. You've seen, and I mentioned earlier, about the EV battery space. Yeah. This is all directed at how do we get more production in Canada so we can export it, so Canadian businesses can be more profitable.
Just want to ask you an inflation question, because it's been the trickiest part of the pie. If interest rates come down and people feel like they can go out and do some more spending, is there an inflationary risk there that the Bank of Canada has to watch? And maybe because a lot of people have talked about this interest rate cycle, at least in the early days, being kind of like a little bit slow and steady.
I think that's the reason why the Bank of Canada would move slow and steady, as you're saying, because you worry that inflation might tick up. We saw that in the U.S. at the beginning of 2024, where consumers were out spending. That lifted things like restaurant prices, travel prices, and we're seeing a little bit of that in Canada. Now, I would also mention, though, that the high inflation environment we got ourselves into post-pandemic was majority driven by supply chain issues. It was majority driven by the fact that we had Russia invading Ukraine, pushing up oil prices, pushing up gasoline prices. Now, that has started to fade. So only about 25% of our domestic inflation was really, or of inflation in Canada was really domestically born. Yes, there is a risk, but we don't think it's going to be one that's going to derail inflation, such that you need to, for example, remove the idea of rate cuts for the Bank of Canada. Yes, it might slow them. It means that we're not going to have a quick rate cutting cycle like we had in the past, but it doesn't preclude the fact that we are going to get rate cuts in this country.
And then let's talk about housing for a second, because obviously higher interest rates is complicated for, being able to afford homes, but it's been difficult to afford homes in this country for a very long time for many Canadians. And part of the growth story for the economy has been higher population, and we're going through some of the growing pains associated with that. But we're not necessarily moving away from a rising population. So I do wonder how you think about whether or not, especially at a time when, interest rate policy leading to lower interest rates, maybe it makes homes more affordable, but we've been talking now for a very long time about our productivity lagging because people have to put so much into the housing market, and there still seems to be a lot of demand supports over the long term. So how does that factor into the ability for Canada to outperform over the long term?
So one thing that we're thinking of with respect to the housing market is how much investment can we actually put into this market. We historically in Canada have been putting a lot of investment in relative to the size of our economy, just because it's been an asset that has been appreciated, so it incentivizes builders to build. We now have the government stepping in and trying to incentivize more building. They have various, excited plans to try to get housing supply to ramp up to housing demand. We don't think that they're going to be able to achieve their targets with respect to how much housing they need to get more affordability in Canada. So it's not like we're thinking affordability is going to improve, but one thing that we do think is going to happen is we do think that building will accelerate. It's just not going to accelerate enough to close the gap in affordability. Now, greater building in Canada also means greater investment. And that's good for Canadian GDP growth. So one of the big driving factors of our GDP forecast over 2024 and into the future over the next 10 years is we think that there's going to be a huge amount of investment from businesses, not just in the production side, manufacturing side, because of the green transition going on, but because we need so many houses in Canada to be able to just house people. And it's not like population. We had a huge population upswing. It's not like population is going to decline. We actually have just population slowing from about 3% to about 1%. That still means more people coming into our country, which means more consumers, which means more demand for housing.
So just to wrap that up, so affordability still kind of a wild card for the economy, but growth from lower interest rates, and whether that's people building or whether that's people having the ability to go out and spend on some other things along with housing that maybe could help our economy. So what does this mean just in terms, you're talking about interest rates being at the center of your thesis here. What do you think is going to happen with interest rates in the United States by comparison?
Yeah, so we think the Federal Reserve is going to be a little slower than the Bank of Canada with respect to cutting rates. Our first cut from the Federal Reserve is in December. So the Federal Reserve is going from 550, right? So we're already at a higher level than the Bank of Canada. And, they're in a situation where their economy really hasn't had any growth sacrifice from higher interest rates. We know Americans are much less sensitive to higher rates. One, because they spent a decade deleveraging after the global financial crisis. So American consumers are in such better position going into the high rate environment than Canadians were. And you look at just even the way the mortgage market is set up in the United States. This is a second factor. 30-year mortgages versus 5-year mortgages in Canada. You're getting more people in Canada resetting on a daily basis here. Whereas Americans, if you bought a house and during the pandemic, you're looking at your entire career before you have to reset your mortgage rate. This is not a similar situation where because of that you have that interest rate insensitivity in the U.S. So consumers are so much better off, and they have been the driving force of American economic growth, which in the first chart you showed is the reason why the United States economy has outperformed not just Canada, but really everyone in the world.